Good afternoon, everyone. Welcome to ASK UP quarterly webinar. Over the past month and a half, we have seen quite a bit of market volatility. Factors like escalating geopolitical tension, election uncertainty, and concerns of subdued global economic growth have deeply impacted the market. So in October and November, BSE mid-cap and BSE 500 indices have been down around 9 to 10%. In comparison, our portfolio has moderately declined by around 7%. So to help us understand the market trends and what lies ahead, we have Chetan Thacker with us today. Chetan handles the EOP portfolio. He has over 17 years of experience in capital markets and has seen many such cycles. So we will divide our session into two parts. In the first, Chetan will share his insights on Q2 numbers, the portfolio strategy, and factors likely to influence the market going forward. Then we will open the floor for questions. So please feel free to type your questions in the chat box at any time. So let's get started. Over to you, Chetan.
Sure. Thank you so much, Pratmesh. And thank you everyone for joining us for this quarterly call. Season's greetings to everyone before we begin the call. Like Pratmesh mentioned, we'll first just quickly take an overview of what is happening in India, what is happening globally, and what are the factors that we believe will influence in the near term. Followed with by which we will basically cover what we've done on the portfolio, how the portfolio is transitioned over a period of time, and then we'll open the floor for question and answers. So to begin, I think on the global event front, which everyone has been glued to and everyone has been keeping an eye out for, we've actually seen a change of guard in US with the Republicans winning the US election. This essentially means that what we are likely to witness is we will essentially see some bit of shift in policy, particularly around energy, trade, and non-trade barriers, which was a part of the Republican manifesto as well. On the other hand, I think China has been a big concern for global growth. What we witnessed in the last quarter is that we finally seen both monetary and fiscal stimuluses being announced by China with an aim to address the slowing growth in the Chinese market. We expect additional measures based on the policy changes announced by the new dispensation in US. Given how the US system works, we will not see the new president in office by the end of January. So it gets instated towards 20th of Jan, post which we will actually start to see policy reforms. What we are right now witnessing is some high-level deputations in certain of the departments, which is essentially pointing towards the people who are getting placed in various important offices as far as the US economy is concerned, but real policy action is anticipated from January. Europe, on the other hand, continues to remain subdued in terms of growth. We are actually seeing lackluster growth in Europe. We've not seen any meaningful pickup in Europe so far. What we've actually witnessed, on the other hand, is we've seen the US Federal Reserve reduce headline rates by 75 bips as inflation there has cooled off. And while US growth has held out globally and has been a good factor in driving the global growth, clearly the balance has shifted in terms of growth versus inflation. However, having said that, the key caveat remains, and that is what has led to a high degree of volatility, not only in India, but across other emerging markets, is the fact that the new dispensation, the policies that they've so far announced during their election campaign, points towards an expansionary fiscal policy. That is where there is a divided view, whether that will essentially mean a higher dollar index and it will essentially probably mean higher inflation, which in turn will mean higher interest rates in US, higher than what was being anticipated earlier. So that is one of the major reasons why we are seeing outflows that continue from emerging markets. India is a part of that same basket, so we are seeing those kind of outflows from here as well. On the geopolitical tension, I think everyone is waiting to see how the new dispensation deals with it. Clearly, those tensions continue to remain elevated, whether it is Ukraine or whether it is the entire Middle East crisis. That continues to remain elevated, and we are not seeing any major moves there in terms of ending those disputes that are there in both in Europe and also in Middle East. So keen eye on what happens from US, both in terms of policy across various sectors, be it trade, non-trade barriers, be it energy, where clearly there is a shift or a large difference between the policy goals of both the administrations. So people are watching out, and we are also watching out very keenly as to what happens there. Second big aspect is what happens to geopolitical tension and how the new dispensation deals with that. Coming to India, I think this year what we witnessed so far is we've actually seen a 50 bip upward revision as far as FY25 GDP growth is concerned by IMF. The sticky issue, which we've been highlighting for some time, is food inflation. Food inflation still continues to remain sticky in India, which is putting pressure on the consumer price inflation, and that still remains elevated, which is essentially providing a very limited elbow room to the RBI to move on the monetary policy front. But we've actually seen a change in stance as far as RBI is concerned. It's changed the stance to neutral versus withdrawal of accommodation. So these are the first signaling signs of probably monetary policy loosening as we look ahead. On fiscal deficit, I think the H1 numbers that have come out point towards 30% of the entire year's fiscal deficit target being met. Clearly, here our expectation was that first half you will see limited spending by the government because the new government was in place only in July, post which you had monsoon. So the expectation is for the second half that we actually start seeing pickup in government spending, which supports growth, coupled with a revival in exports, which was also a laggard as far as last year is concerned. So we expect H2, you will actually see increase in government spending. You will actually see revival in exports. Most of the managements are highlighting that probably towards Q4 is where you start to see exports start to pick up pace. We anyways have a very benign base starting from the fourth quarter onwards or second half of FY25 onwards. Coming to consumption, consumption has been a mixed bag so far. We've actually seen two-wheelers demand has held out, which points towards rural doing better than urban. Most of the commentary is also pointing towards that rural is doing better than urban. Urban, there is some degree of sluggishness. On the other part of the consumer discretionary, we've actually seen durables report strong growth, while other discretionary segments, be it footwear, be it clothing, be it QSR, we've actually seen a muted performance thus far on the consumer discretionary side. The early festive numbers that are coming out, particularly from two-wheelers, who are particularly from the auto pack in general, which is first to report, points towards 11 to 12% kind of festive growth in two-wheelers. So two-wheelers clearly is a silver lining as far as discretionary spend is concerned. PVs is close to 7%, while CV and tractor is relatively flattish. So that points towards a mixed bag kind of performance as far as discretionary spend is concerned. We now get into the post-festive period. What has also led to this mixed bag performance is the fact that monsoon got extended by 1 month, which meant that harvesting itself got pushed out by 1 month, and festival this year was early. So that left limited income in the hand of the consumer to spend. So we are seeing some degree of that impact also playing out. As we look forward, the expectation is that government spending and exports will be the drivers of pickup in volume growth in the second half. On the consumer discretionary and the consumption side, we still expect a mixed bag kind of performance because urban continues to remain sluggish, while we are seeing some degree of rebound as far as rural is concerned. As far as our focus area is concerned, we continue to remain focused on the infra manufacturing theme and consumer discretionary. Essentially, you would have seen over the course of last 15 to 16 months, we've transitioned the portfolio towards themes which we believe will be drivers of growth in the medium to long term. So that continues to remain in place. We still continue to believe that manufacturing and infra will be a key area of focus. That is where the spends will happen from a more medium to long term. And at some stage, you will actually start to see pickup in consumer discretionary as well as income starts to move up. The risk clearly remains. One is the geopolitical tensions that are still elevated. Second bit is on how policy changes in US happen and what would be the impact of those policy changes in the world. So that clearly is a risk. We are keeping an eye out over there. The third risk is sharper deceleration in global growth. That if we don't see monetary action supporting global growth, and if China fails to recover as far as growth is concerned, we might be in an environment where global growth remains sluggish. So that still continues to remain a risk as we look ahead. Coming to the benchmark index, like Pratmesh mentioned, we've seen a sharp fall in the month of October. Essentially, what that has meant is that the forward valuations for the benchmark index are now closer to the mean. They were trending higher than the mean for close to a year now, but we've seen some degree of correction there, and it has approached the more longer term medium valuations for the benchmark index itself. Coming to earnings, which is a key factor which essentially will drive how returns are made over a period of time. Over here, again, there is a mixed bag performance as we were anticipating. On the automotive side, two-wheelers have done well. So anything which is linked to that supply chain has done well, both in terms of volume growth. That has supported also margin expansion. So the entire two-wheeler ecosystem has done well. While on PV, CVs, and tractors, the growth has remained muted. The expectation is with festive, we will see a fair degree of correction as far as inventory on the PV side is concerned. Most of these companies typically take their annual maintenance shutdown towards December. That is the end of the calendar year. So our expectation is that the inventory adjustments will happen as we look ahead in a quarter or two, and the inventory overhang should be out of the system. The focus will then again shift on how spending happens, particularly starting March and April, which is the post-Rabi season. Silver lining in all of this is that this time around, water reservoir levels are relatively healthy, which means that we expect a good winter crop as we enter the winter crop period. Coming to banking and financials, this is one pocket where we were expecting higher cost of funds to impact NIMs. So that is what we are seeing has played out, which has also limited the bad growth. We've seen increase in credit cost, which was also an expected line. So both these factors we felt would have impacted the lending side of things, and that is where we are seeing those things are playing out in Q2. If the RBI moves towards the end of the fiscal year, the NIMs will still continue to contract because you will see assets getting repriced. So particularly companies which are more exposed to the repo linked rates on the asset side will see a faster transmission. This will be the first time when we will see a reverse cycle play out on the transmission of policy action moving downwards. We've seen a positive of that play out in the last 2 years when RBI moved to increase rates rapidly, which meant that there was a very fast normalization of ROEs. So this is the first time when we will see that reverse action play out. On companies which are exposed to more capital market, I think that has been a pocket which has again stood out. We've actually seen robust performance both in terms of earnings and stock prices. That is an area that has done well. Our sense is there are pockets there which can continue to structurally do well, while valuations to a certain degree capture that, but that is an opportunity space. While lending might still see muted performance, particularly if we see RBI moving towards easing monetary policy. On consumption, Q2 was expected to be weak. It has been weak in line with expectation, barring consumer durables, where we've actually seen growth outpace what was estimated at the start of the year, particularly because of the extended heat wave that has played out this year. That has meant that the durable bit has done well, led by ACs. We've also seen a fair degree of pickup that has happened on the refrigerator side as well. Coming to festive, I think so far the commentary from management has been mixed. Festive demand obviously has not been as robust as was anticipated, driven by two factors that we mentioned. One clearly was an extended monsoon. Second is the fact that that festive season being early and monsoons getting extended has meant that there is limited income in the hands of the consumer to spend. And typically the kind of spends that we see in festive, we've not seen this time around as well, and it's been a mixed bag. A positive thing is we have a higher number of wedding days this year around in Q3, which essentially means that spend there should be higher, which to a certain extent should partially offset the muted performance we've seen in the festive period. Coming to chemical and pharmaceuticals, pharma intermediates, what we've witnessed is the destocking still continues. We are seeing pricing pressure, particularly driven by how China is behaving in the global market, which has negatively impacted pricing and in turn negatively impacted margins. Our sense is we are towards the end of this cycle. Most of the commentary points towards that H2 will start to see recovery in volumes. Most of the inquiries are pointing towards pickup in volumes, particularly from Q4. So the expectation is you will start to see volume-led recovery on the export front, while pricing may still take some more time and it will be dependent on how China decides to move ahead here. But volume growth will start to pick up as far as the agrochemical/pharma intermediate segment is concerned. On engineering and industrials and capital goods, this has been a segment which has got impacted both by elections and prolonged monsoon. So the expectation is with government spend picking up in H2, this segment should start to see recovery in both volume growth and in earnings growth as we look ahead into H2. On OMCs, clearly refining margins were under pressure in second quarter. We've actually seen that play out in terms of numbers along with losses on the LPG business. As we enter the winter season, this is typically seasonally a strong period as far as GRMs are concerned. So we're actually seeing uptick in GRMs, plus marketing margins continue to remain healthy. So the expectation is that H2 in terms of earnings will be way better than what we witnessed in H1 as far as OMCs are concerned. On pharma and healthcare, pharma growth has been in line with expectations, so domestic volume growths have been stable, while lower input costs there have helped margins, leading to margin expansion. So earnings delivery has been in line with expectation. Similarly, on hospitals, we've actually seen patient volumes remain steady, though there has been a limited increase in RPOP because last 2 years we've seen significant increases in RPOP as well, which has meant that revenue growth has tracked volume growth to a large extent, and there has been operating leverage because of higher patient flows, which has supported margins. So, in a nutshell, overall, when we look at Q2 earnings, we were expecting a weak set of earnings. We've actually got weak set of earnings. One pocket or area where we've actually seen downward revision of earnings is clearly the consumption spend, which has not been as good as anticipated. While the silver lining is that H2 with higher government spending, the reservoir levels remaining healthy, we should start to see uptick in volume. For the market as a whole, this has meant that we've seen a downward revision as far as earnings are concerned. So FY25, from a benchmark perspective, is now expected to be muted. We will actually see 12 to 13% PAT growth. So there is some degree of downward adjustment of expectations that is happening as far as the benchmark is concerned, which is also a factor which has added to this correction along with how flows have moved. FY26, we still continue to expect recovery will start, driven by volume growth, particularly on the consumption side, and the fact that H1 of this year is a benign base for H1 of next year when it comes to the entire infra capex/engineering pocket, where we should see reasonable growth in the first quarter of next year as well. As far as this quarterly earnings are concerned for the portfolio, we've seen operating profit growth of 18%, PAT growth of 24%, which has been higher than what the benchmark has delivered. The benchmark has been in high single digits, while we are closer to the 20% mark on operating profit growth. PAT growth continues to remain robust and upwards of 20%. When we look at the actions that we've taken in this particular fiscal, so in line with what we were trying to do is the repositioning of the portfolio, and also the fact that there is an increase in churn as we look to get into names, book profits, and move out. So that has played out as far as this fiscal is concerned. So you'll actually see names such as CDSL, which gave us reasonable return. We've entered and exited in the same period. Similarly, Honeywell Automation is a name where we would have entered, book profits, and moved out. There are other pockets where we've strengthened weights, particularly on the discretionary side. We've added a Varun Beverages. Gravita, again, is a name which is more focused towards the entire recycling and sustainability ecosystem, and that is a name that we've added to the portfolio in this particular fiscal, and we've increased allocation as far as utilities is concerned by way of both Adani Energy and Adani Ports. At an overall level, as you can see from this slide, what this has meant is that infra and engineering exposures continue to remain elevated. When I look at the manufacturing exposure in total, which includes subsectors such as infra and engineering, automobiles, one part of healthcare, chemicals, that weight now stands to closer to 60% for the portfolio. Second big weight there would be consumption, which is closer to 14% in the portfolio, where the weights have essentially come from. So spaces where we've increased weight significantly is healthcare, which has gone up to 14%. This again now is a combination of both pharmaceuticals healthcare providers, and also the opportunity on the medical devices side. So all the combination of that has meant that the healthcare exposure in the portfolio has gone up. Similarly, automobiles is a pocket which we believe will structurally do well. So that is another space where we've increased allocation, and that is moved up from 2% to 10% over the course of the last 1.5 years. Utilities, commodities is Gravita mainly. So utilities, energy and commodities put together is another pocket where we've increased weight by 13% cumulative in the period of the last 15 years. So this is primarily in line with where we see things moving, which is essentially infra, capital good manufacturing doing well over the medium to long term, followed by consumer discretionary. So that is clearly visible as far as our portfolio allocations are concerned. From where this weight has come from, largely, one is clearly financials. So today we have exposure which is very limited to NBFCs in the portfolio. We essentially had bought CDSL, which was a capital market play. We booked profits and moved out. So financials is a pocket from where weight has come off. The second pocket from where weight has come off is consumption. It's largely a blend of some degree of staples and certain discretionary names which we've moved out of to create space for the other sectors where we wanted to increase allocations. Similarly, chemicals is a pocket where we've rejigged some degree of weight. So chemical weight has moved down in this period, while that has got compensated by increase in weight in healthcare in particular. So in summation, we continue to remain exposed to infra manufacturing / capital goods, which is a larger weight, followed by consumer discretionary, followed by utilities and financials. So that is how the portfolio is structured at this point of time. Coming to returns, like Prathamesh mentioned, we are starting to see some early signs of the portfolio outpacing the benchmark. We can see that in the 1 month, 3 month, and 6 month performance. Our expectation is with the changes that we've made to the portfolio and the fact that earnings are significantly better than the benchmark, we will actually continue to see this outperformance as we look ahead, as well as is visible from this side that the portfolio remains superior as far as quality is concerned. When we look at the ROC for the portfolio, which is closer to 33% for FY26, EPS growth in this period is 24% for FY25, which is higher than what we are pegging for the benchmark, which is closer to 12 to 13%, followed by a 29% growth in EPS in FY26. So clearly the portfolio is positioned in high quality and high growth. Over this period, what we've also witnessed is PEs contracting. If you look at March 21 to October 24 in terms of 2-year forward PE, we've actually seen some degree of compression as far as valuations are concerned for our portfolio. So the expectation is that we get compensated for the earnings that has got delivered in the last 2 years, but has not got similarly reflected in terms of returns, plus the fact that we are continuing to see higher earnings delivery from the portfolio compared to the benchmark with a superior quality. So the expectation is we continue to build on to the outperformance that we are witnessing in the near term. So the expectation is as we look ahead into FY25-26, a combination of higher earnings growth coupled with some degree of re-rating and the fact that it continues to remain high as far as the top quartile as far as quality is concerned, as measured by ROC. So the expectation is we continue to play this catch up as we look ahead into medium to long term. While from a very near term perspective, what we are keeping our eyes glued on, one is policy action, which we see coming out from US, how that plays out and what that means as far as economies globally are concerned. Very clearly, while there is an anticipation of across the board tariffs being implemented in US, the fact is that relatively it will still be beneficial to India if you actually see a higher tariff for other trading partners of US compared to India. So that should bode well as far as the entire manufacturing theme is concerned, because not only is it capturing the higher domestic growth, it is also capturing the higher opportunities that will open up as far as exports are concerned. The second big monitorable will be government spend as we look at the second half. So the expectation is government spend starts to pick up in second half, which should support growth, coupled with the fact that exports have a very benign base. So exports should also be a driver of recovery as far as earnings are concerned. As we look into FY26, clearly the first half will have a benign base for engineering, capital goods, manufacturing, given that this year first half was plagued by obviously the government election, which meant that slow decision making as far as government is concerned and spends, and also the fact that we had an elongated monsoon. So both these factors mean that H1 of next year will also see a very benign base. So as we look ahead, clearly Q4 is where we start to see pickup in earnings. Q3 we will start to see some degree of silver lining as far as earnings recovery is concerned. Expectation is we continue to build momentum starting Q4 onwards, and that will run through FY25 and 26 and 27. With that, I will just pause here, Prathamesh, for questions that are there. Thank you so much.
Thank you, Chetan. That was very insightful. So that brings us to our first question. What most of the market participants and clients today want to know is that about foreign FII outflows. So foreign investors have been garnering a lot of attention. In November also, they have continued to be net sellers. So you spoke about this in the first half of your presentation. So is this a reaction to September quarter numbers, or is this a reaction to US election results? So, and what kind of impact will this have on the markets and on our portfolio?
So, Prakash, like you rightly mentioned, it's combination of both the factors. The first factor is that earnings are getting downgraded. There is some degree of downgrading of the entire fiscal year earnings that we are witnessing. So one impact is because of that. Our sense is we are seeing close to 2 to 4% kind of knockoff of the earnings growth for the fiscal itself. So there is some degree of that impact. Second larger impact is also from the fact that we will now see a change in policy from the US, which can essentially mean that fiscal deficit in US remains elevated, which means that interest rates might remain elevated there, and that is providing fair degree of support to the dollar itself, which is also leading to outflows from emerging markets. So it's a combination of both these factors. If I recollect correctly, by the end of last fiscal, which is March 24, the FII ownership of the market was closer to 17.5, 18%. So we are actually seeing that pocket driving the selling. We continue to see robust inflows as far as the domestic flows are concerned. So while that is supporting the market, but we are seeing some degree of readjustments even by FIIs, given that no one is too sure of how the new policy will play out. We will get some clarity of that as we start moving into the period of January, as the new dispensation takes office in US, and we start to see policy announcements from there. So the expectation is in Q4, we will have fair degree of sense of how the policy action is getting changed in the US and how that will impact the various economies. Even when we look at the fiscal stimulus announced by China, it's still not a very large fiscal stimulus because they too, our senses are waiting for the final policy shift that happens from US before going out and announcing the next leg of fiscal stimulus. So everyone is probably holding out for the time being to see the new president in place and the shifts in policy. So it's a combination of both the factors. The fact that earnings have been a tad lower than what was expected at the start of the fiscal, because everyone was aware that there is elections. So first quarter and second quarter would have got impacted as far as spend is concerned. What has largely led to a drag is the fact that monsoons got extended by a month, which meant that the expectation of a pickup on the consumption side, particularly on the discretionary side, has got pushed out. Silver lining is higher marriage days this year around. So clearly, a combination of all these things has meant that earnings have got downgraded, and the fact that there is a change in policy. So there is that degree of apprehension as we move towards the end of the calendar year.
Okay. Has this FII selling created any long-term opportunities for the investors, and especially because FIIs tend to invest in the pocket of quality and growth. So has this recent selling actually led to any long-term opportunities?
So clearly what we are witnessing is certain names, certain pockets where we were keeping an eye out on have got more attractive. So we are building positions there. Our sense is that as this selling happens, it will obviously throw up an opportunity because we still firmly believe that from a medium to long term, growth will be higher in India because it's supported not only by what is happening globally, it is also supported by a robust domestic consumption growth. So, medium to long term growth will be higher in India. This correction will provide an opportunity, and we will take advantage of where we want to build weights. If those pockets correct, we will probably look at continuing to build weights there.
Okay. So especially the second half of 2024 has been extremely volatile, whether it's election uncertainty or macro issues like oil prices. So in this period, we have seen that quality growth stocks are getting traction. So can we see like a style rotation taking place in 2025 or in the remaining part of 2024, wherein the traction moves from value and momentum to quality and growth?
So what we've been highlighting for some time is the fact that a sharp rally that we had seen on the value side was a rally which had come after a period of 7 to 8 years. So there was a fair degree of re-rating that happened there. Post the re-rating, the focus obviously shifts to growth because that is the biggest differential as far as value and growth is concerned. We firmly believe that without growth, you will not see wealth creation. So very clearly, the blanket re-rating that had happened for the value side, our sense is we've probably seen a completion of that cycle. The focus will shift to quality and growth. Even within value, if we actually start to see names which start to deliver on growth, then they will still continue to outperform. But that will mean that they would have shifted their bracket from value to growth. So even when we are looking at the entire value pack, where we've seen a larger re-rating, that is the pocket where growth, the rate of change as far as earnings are concerned, even in that pocket has got accelerated. Only when we've seen an accelerated re-rating there. So clearly, growth remains a biggest factor from a more medium to long term perspective. So our sense is, yes, the market will become more stock specific as far as the value side is concerned. As far as growth and quality is concerned, clearly there has been earning growth in this pocket for the last 2 years, but we've actually seen that pocket derate. So to a certain extent, we should start to see the differential open up because there is a differential which keeps opening up now when we look at the value, the growth of all the value names compared to the growth that is getting delivered by the growth pack and given where valuations are. So our sense is yes, you should continue to see this opening up of differential, primarily driven by the differential in earnings growth.
Uh, s- So this brings us to the question related to the September quarter results. We have seen that companies which failed to meet the expectations, they were battered or the stocks sharply declined. So does this show that in this period, will quality stocks like quality management, the importance of quality management, companies with high ROC moats, will they outperform or how will be their performance as compared to the broader markets?
So clearly, what we've seen, particularly since the COVID time, is that environment is becoming all the more challenging by every passing day. So any management which is more proactive as far as taking policy decisions or actions or strategy decisions is concerned, will be better able to manage the uncertainties that are there in the environment. So clearly, quality of the management will be a biggest differential as far as how managements react to the changes in the environment. One, when we look at it even from a very micro level, what we see is that managements which have been very nimble footed, aware of what are the changes in the market, despite a weak environment, have delivered better earnings in this first half as compared to management which were more dependent on the environment lifting earnings itself. So they have seen an uptick in earnings when the environment was good. In this period where you've seen higher volatility, earnings there have been patchy. While in most of these names, what was being factored in was execution, which remains top notch. So wherever we've seen a miss in execution, I think valuations have taken a beating, which has led to this sharp fall or sharp correction. It is nothing but adjusting to uh, the current reassessment of growth in those names. So that is the adjustment that we are witnessing. Having said that, very clearly from a medium to long term perspective, both quality of business and quality of management are interlinked. So you need a combination of both these factors to ensure durable, high quality growth in a medium to long term, because a high quality business with an inferior quality management will also not deliver an outcome. Similarly, a high quality management with an inferior quality business will also not deliver an outcome. So clearly, it's the combination which will deliver an outcome. So our sense is, from a medium to long-term perspective, we still firmly believe that both quality of business, quality of management, and growth are the ingredients which should lead to creation of wealth over longer term.
Okay. So talking about the performance of our portfolio, both in terms of the returns as well as in terms of the business performance of the portfolio companies. So do you believe right now the ground is much more fertile for our portfolio companies to bounce back and the price to catch up with the performance?
So what we are clearly witnessing is that in the last 2 years and also in this H1, like I had shown in the slide, clearly our earnings growth has not disappointed us. So for the portfolio as a whole, even in the last 2-year period when we were underperforming, and even in this first half, so far we have outperformed as far as earnings growth is concerned. What has been missing is the fact that we had seen compression of valuations in this pocket, which has meant that you've not seen a similar translation of the growth to returns. As we look ahead, our expectation is that as that differential of growth keeps opening up compared to the benchmark of the portfolio, quality remaining high, you will actually see the portfolio starting to outperform. So yes, the period is more fertile for quality businesses and quality management, because as the environment remains more volatile, it is a period where you can distinguish a good quality business, good quality of management compared to the other companies. In an environment which is very buoyant, you typically tend to paint every company with the same brush, because that wave itself lifts all the boats together. So in an environment which is more volatile is where you can clearly see a distinction. Our expectation is, like we've seen even in Q2, where our portfolio companies have actually delivered 24% PAT growth in an environment which has been very weak. It clearly shows that quality businesses, quality managements, irrespective of environment, will do relatively better. It doesn't mean that the environment does not affect them. Environment affects everyone. But that quality ensures that they are more nimble-footed, to ensure that even in a weak environment, they are able to deliver much better outcomes compared to the market at large. So the ground is ripe for us to continue to open up this differential.
So, sticking to the portfolio action, over the last 1 year, exposure to healthcare sector has gone up significantly. So, can you explain the rationale behind this and which particular pockets within the health sector do you find attractive?
So if you look at our healthcare exposure today, it's a combination of all the three subsegments, which is pharmaceuticals, healthcare provider by way of hospitals, and by way of exposure to polymedicure, which is again med device space. So when we look at this space, clearly there is a government focus pushing for medical devices to be manufactured in India, pushing for making those devices more uh, affordable as far as the Indian population is concerned. So that means that anyone who can manufacture similar quality of product at a reasonable price will do well. Similarly, we are witnessing a shift as far as the global health spends are concerned. Clearly, there is a focus on reducing health spends. As the population ages, that burden continues to go up in the developed world. So they continue to look for players and suppliers who can provide them these affordable solutions. So our exposure to healthcare is combination of all three. Clearly, on the healthcare provider side, India still continues to remain under-penetrated when we look at number of hospital beds compared to populations. Even in a city as large as Mumbai, you can count on your fingertips which are the hospitals where you want to essentially go to, and there is a scarcity even in the financial capital of the country. So clearly, there is an ample space for the provider ecosystem to develop and for growth to be captured there after a long period of time. What we are witnessing is that the capexes which these companies are doing is not creating a drag as far as their balance sheets are concerned, because cash flows remain healthy. So they are today expanding in a very prudent manner while not impacting the ROCs. So ROCs which have moved upwards of 20% continue to sustain in that higher zone while they create more capacity. So clearly, we like the entire pocket, which is pharmaceuticals, where you have a very strong base of domestic volume growth, given the sheer size of the market in India and the population size itself. The fact that we continue to remain a dominant generic player in US, where the environment has become tad bit better, than what we were witnessing earlier. So while price erosions are happening, they are in single digits as compared to high double digits, which was witnessed earlier. There is some degree of scarcity that has also got created in that market. So clearly, exports, companies which are exposed to domestics, so the domestic side provides stability, while exports provides an opportunity on the farmer side. On the provider side, there is a large opportunity that sits there with the fact that most of the balance sheets are now robust for particularly the larger players. That creates room to increase capacity by not impacting the return metrics for these businesses. Similarly, on the med device side, so it's a large opportunity to play both on the domestic and on the export front. So that is where we've increased exposure. So practically from nil exposure to that pocket to closer to 13% of exposure by this time around. It's a combination of both our actions in terms of increasing exposure and the fact that those names have done well. So that has also added to that increase in weight. So it's a combination of both these factors.
And also, do you see health sector or any other sector as a defensive play, especially in uncertain macro conditions currently?
No, so clearly, health is a pocket which remains defensive because of the fact that you can't postpone beyond a period of time. You can't postpone taking your medicines for chronic diseases. So it clearly is a classic defensive to that extent. Certain pockets will see higher accelerated growth. Something like a Polymedicure will still continue to deliver upwards of 20% earnings growth, while the entire pharma pack and the provider pack might see 17 to 18% kind of PAT growth. So you will not see upwards of 20% growth, but it's a more certain, durable growth because of which we witnessed re-rating in that pocket, and we are not seeing any sharp downward revision as far as valuations are concerned in that pocket as well. Because as long as these managements are able to maintain fiscal discipline as they expand, our sense is valuations here will sustain, given that both quality and durability of earnings and certainty is higher in this pocket.
So also the last 12 months, the exposure to consumption has come down. So how do you plan to play this space going forward? I mean, do you see with the inflation inching up, do you plan to cut down the weightage, or are you cautiously optimistic about this space?
So we've actually seen a fair degree of reduction in weights there. The way we are approaching this is we still firmly believe consumer discretionary will do well over a medium to long term compared to consumer staples. Certain names there which we liked had valuations which we did not like that much. So I think this correction is providing an opportunity. So our sense is anything which is more distinguished consumption will continue to do well. We are right now witnessing some degree of headwinds, like you rightly mentioned, because of inflation and the fact that incomes have been impacted because of inflation as well. We are seeing those factors play out. Our sense is Q2 was probably worse as far as those numbers are concerned. We'll start to see an uptick starting from third quarter, and that should continue to gain momentum as we move into the next fiscal, because most of these companies have actually not slowed down their store additions or retail space additions, or the fact that they've continued to increase the addressable market. So distinguished consumer discretionary should continue to do well. I think this correction is providing an opportunity from a valuation perspective for us to increase weight as and when we feel right. So our sense is we are incrementally positive. The only thing that was holding us back was valuations. We are now starting to see some degree of correction there. So when we are more comfortable, we might actually see weights that go up.
Even in terms of the sectors, the highest exposure is to infrastructure and manufacturing. So in this particular space, any pockets that you find extremely attractive, or any particular theme that you are looking to play over the next 1 or 2 years?
So on this pocket, our sense is it is a vicious circle. What we saw was the way this started was particularly by way of government policy action on PLI. So it's one thing linked to the other. So the PLI basically provided ample amount of time for the companies to create economies of scale as that ecosystem develops. So just taking an example of, say, entire mobile phone assembly, which started off with the PLI ecosystem. So the government announced the PLI on mobile phones. You saw trade and non-trade barriers go up there. That meant that the assembly opportunity, which was being serviced by Southeast Asian countries, moved towards India as government pushed these companies and the OEMs to assemble in India. Now, when you look ahead from here, the first leg of the journey is done, which is assembly. Most of these companies will now move towards the backward integration of the supply chain. So it's a ecosystem that is getting created, and the power of the ecosystem means that 1 + 1 might equal 4 as that ecosystem continues to develop. So our sense is that with the government policy action, you have a firm base in place. And now what you're starting to see is that entire ecosystem getting created, which will mean that a larger part of value addition starts to get captured in the country itself, which will mean that if a right business model is adopted with a higher value addition that is getting captured here, you are only going to service a very large domestic consumption base. You will also create an ecosystem for the export market. So a lot of global OEMs might still have a concern saying that, look, the supply chain somewhere is still linked to China. But if you're able to create that ecosystem where you continue to reduce the reliance of inputs coming from outside and you create that ecosystem internally, that basically fuels more towards getting these supply chains into the country. So it provides more comfort to the OEMs to say that a large part of value addition is happening domestically and locally, which means there is a higher degree of control on the supply chain. So our sense is that entire pocket will do well because of this entire vicious cycle where one subsector will feed into the other, and that will continue. So even if you look at, say, the solar cell module, so it started with the module assembly. Today, you moved into solar cell manufacturing. Further down, you will essentially move into wafers as well as look ahead. So clearly, that entire ecosystem is getting developed with one fueling the other and the other fueling the third part. So clearly, it's the sum of parts will be more than the simple addition of those parts.
So EOP has fair bit of exposure to mid cap and small cap segment, which have witnessed a strong rally over the last 1 year. So what are your expectations from this segment going forward, and especially in comparison to the large cap stocks?
So we very clearly remain very focused on bottom-up delivery of earnings. So that has been our focus area. So while we look at the market caps, our sense is that even in the entire market space, irrespective of market cap, any company which will continue to deliver bottom-up on growth while maintaining or improving quality, you will still continue to see outperformance there. Pockets which will disappoint compared to the expectations that have got built into those names, you will actually see these sharper corrections that we are witnessing in the marketplace today whenever there is a miss in earnings. So our sense is that difficult to paint the entire segment with the same brush. Focus still continues to remain more bottom up to see where there is earnings delivery, to see where there is more certainty and predictability of earnings, and create exposure there because that in a way will outperform over the medium to long term.
Okay, and looking at the overall market, like there's been extreme bouts of volatility. So do you think that this will continue over the next 6 odd months, or do you see the market simmering down?
So
And
our sense is
the factors that would eventually lead to reduction in volatility.
So our sense is volatility, the source of the volatility is two-pronged. One is clearly the downward adjustment of earnings. So I think with time, you will essentially see that part of volatility getting reduced as expectations are reassessed and brought down. So volatility associated with miss in earnings gets factored in into the prices. As far as the volatility related to global policy shifts and changes are concerned, our sense is as those get unveiled, as we move into the first quarter of the next calendar year, you will see some degree of volatility from there also getting addressed, and there will be people will essentially know where the policy changes are happening and what is the response that is getting delivered as far as those changes are concerned. So as we look ahead, one part will probably get addressed faster, while the other part we'll still have to wait and watch for the first quarter of the calendar year 25.
Okay, Chetan, thank you very much. Thank you very much for those insights. With that, we'll conclude this session. Thank you everyone for attending it. We'll see you again next quarter.
Sure. Thank you so much, Pratmesh. And just to summarize as to what we've seen so far, clearly over the last 15 months, we've taken fair degree of actions to realign the portfolio to where we want this portfolio to be from a more medium term, long term perspective. In terms of earnings, the expectation is you will start to see uptick starting Q4 driven by higher spends from the government, driven by revival in exports, followed by uptick on the consumer discretionary side. We are seeing early signs of outperformance of the scheme compared to the benchmark index. We are cognizant of the fact that we still need to catch up significantly. So the expectation is what we've seen in the last 6 months, the fact that our changes lead to some degree of outperformance compared to the benchmark, plus the fact that re-rating of this particular style also adds to the catch up as far as the performance is concerned. When we look at it very organically, the focus still remains to create and build a portfolio which outperforms the benchmark in terms of both quality and growth, which in turn leads to a faster catch up compared to the benchmark. We continue to open up this gap of performance between the benchmark and the scheme. And anything which is over and above this in terms of re-rating will be a bonus that gets added there. Very difficult to say how fast, how quickly that happens. But what we've witnessed historically is whenever re-rating or de-rating, both these cycles happen, they happen very quickly in a shorter bout of time. So the expectation is that will also add to the outperformance as we look ahead. So with that, thank you so much for joining in. We expect earnings divergence to continue to remain or open up for our scheme compared to the benchmark. And there is an expectation that we continue to build on to the outperformance that we've seen in the near term. So thanks so much for joining us. We will again speak in the next quarter. Thank you so much, Pratesh.
Thank you.